Well, I think it's time, and so we're just starting our third in the series of webinar chats towards the BITOSA global event. Um, the BITOSA Global Conclave is in Bangalore in the Hotel Lalit on the December 1st this year. Um, it is probably the first event which the techies are organizing for the techies, and we are discussing tech in that conference in the context of what it means to the tech worker. So in the run up to that, this webinar chat series has been very fortunate to have esteemed guests here. And today, there is no exception. We have with us Mr. Rajesh Srivastava, who is a veteran in the technology industry. He also happens to be an alumnus of the Birla Institute of Technology. So that gives us double the excitement for this particular edition. Um, Rajesh is the founder and CEO of priceSeries, a very successful software and services venture for the trading business. It is something, when I spoke to him, he mentioned that it was something that is relevant more for more professional traders. However, we were fortunate to have him here to help a lot of us who are amateur traders to sort of understand some of the fundamentals of how trading works and how technology helps us in maybe becoming richer than we are. So welcome to the chat series, Rajesh. It's great to have you here.
Thank you, Subhash.
So Rajesh, let's get this started off right away. And you come from a very technology background, and you've had tons of years of experience in technology. So how did you? What made you switch to something which I think a lot of the business guys and the MBA guys end up in, which is stock markets and trading?
Yeah, interesting question. I've been in software field for a long time, and also privately, I had a passion for trading. So I've been trading since actively since 92, 93 timeframe in U.S. markets, and those were the times when we used to buy and sell using the phones. You had to call your broker. But technology over time changed and made it very accessible for everybody, including myself, and go on to online trading. And, since I would rather say 2000 onwards, we have actually seen a very gradual change initially and then exponential change now, which we have seen. So that's how I got involved. And I've also been in the data security business, whereby I was working on a lot of algorithms. And I just combined my passion and technical algorithms to form priceSeries, where we use AI and deep machine learning to predict and forecast what happens in the market to stocks.
Wow. So technology and trading have come very, very close, and that probably was a trigger for you to get into this full time. As most of the techies attending this particular web chat series, I think that's great news, because technology has not been seen as something that you make money out of, right? It's more an enabler for most of the core businesses. But it looks like stock market trading, from what I'm hearing from you, is something which has become very close and almost driven by technology now than ever before.
Actually, the truth is that Silicon Valley technology companies were driven by financial markets. It's the other way around. And you'll be surprised that, when we say 2000s or 90s technologies like TIBCO, Sun Microsystems, the first break to all these companies was given by guys like JP Morgan, Goldman Sachs, because their back end was it always had the technology, bleeding edge of technology. The front end did not have. Now, what is happening is that technology is now moving to front end also and making it easier for their customers to be able to do business with them. One of the issues is that the financial industry is a very heavily regulated industry. So there are certain things which they can do, certain things they cannot do, and they are basically overseen by several agencies. So as a result, they could always have a full automation at the back end, but front end to the customer, they were not able to give or provide much of technology used to them. Now things have changed in the sense, and let me give you a side example here. uh, we all know the Bloomberg terminal, which traders used. It was introduced as probably early 80s or late 80s, sometime around that. That terminal business, Bloomberg was making over $7 billion a year on just that terminal business. And they're charging 2K per station per month. That is 24K per station. And they had 320,000 stations worldwide. So that makes it 7.6 billion or so. What has happened is that business is now coming down because all of the Bloomberg businesses, media, TV, everything else just did not work for them. It was a marginal business for them. This was the main thing. Now Bloomberg is going down. With the space left by Bloomberg terminal is actually being occupied by companies like us. And this market last year, 2017, it had a record growth, and actual returns on this market was $28.5 billion. So huge market. And there were several regulatory changes which actually allowed independent advisory companies to come in. If you recall, Citibank, Capital IQ, S&P 500, they all had huge back offices in Sheeps, in Gurgaon, in other places. And there they were employing thousands of people, churning out a lot of research. But IRS actually came in, they were not paying taxes on that. And that was a $20 billion a year loophole, which everybody was actually using. Now that they closed sometime around 2011. And that exactly was the time when the priceSeries idea came to my mind. 2012 is when I actually started thinking about it seriously and thinking about how to bring it out. In 2015, we started the company.
Oh, wonderful. So before we get into a little bit deeper into what technology can do, I wanted your views on there have been two sides, or rather two schools of thought when it comes to trading. One is people who strongly believe that it is the fundamentals of the stock, of the industry, that one should learn about before you get into trading, and that should guide your trading discipline. And then there is another school of thought that says, hey, data is everything. If you can study the data right, if you can track how data has moved in the past, you are able to predict the future. And I think most student traders end up using a little bit of both fundamentals and technical. Where are you on that thinking? Do you think technical analysis trumps fundamental, or the other way around in your trading philosophy?
So I actually take the middle road here, very frankly, and either pure technical or pure fundamental, at least in my opinion, does not work. You have to have a mix of both. Pure, Warren Buffett style of investing for 20 years. Frankly, the guy just got lucky, timing wise. But do you know that he filed for bankruptcy 2 or 3 times before? So nobody talks about it. We just talk about his successes. We'll find people who would say, "Hey, I should have bought Apple, whenever it was 90s." Frankly, people did buy. So the buy Apple and similar companies just based on what you call fundamentals. The problem was there were 200 other companies which went down during this period, and nobody talks about it. So what we should be looking at is pure common sense. Okay, you want to invest in companies which are making money. Whether the company is going to make money 20 years from now, I believe that's a way too far, because the markets will change, technology will change, and people who leading the execution may not be the way you want it to be. Okay, so they may not deliver what you're expecting. So as a result, I would rather look at it in a way that I say, hey, if the company is making money, that's the positive thing, and that's where the fundamental comes in. There are few ratios which you can actually use. That's for stock selection. But when you trade, you actually go into the technicals purely. And because all you are doing is, if you select a good company based on basic fundamentals, you don't have to go into analysis leading to paralysis kind of a scenario. Don't overanalyze. Just want to look at, pure Birlaji mentality, whereby you have, hey, this company is making money. The quarterly growth is there, yearly growth is there. There is a good market traction. There is a good volume on the stock, and then let's find a technical opportunity to put in money and make money out of it. I mean, that's the route, at least, most of my algorithms and the company's product stake. That's what we do.
So you're saying that um, the newer algorithmic trading and algorithms that help traders and the newer technologies that we are hearing about, like artificial intelligence and machine learning, are they really playing a very important role now in making trading decisions?
Yes, they are. So, like, I'll give you an example of what we try to do. So the market is always, moving up and down, and what you want to be able to do is, I mean, a pure technical analyst is only going to look at today and is going to predict, what is going to happen. Now, there are a few things to it. The percentage of accuracy of that kind of prediction is slightly lesser. What we proudly say is most of our predictions turn out to be 80% plus, fairly accurate or near the forecasted point. The reason being, we actually normalize the data for last 20 years or for stocks, since IPO, if they are less than 20 years. We actually look at that whenever the stock has moved up along with the volume and certain characteristics, we actually come up with what we should call a score, and a score for that particular stock. And each stock is different, by the way. Their behavior is different. Their movements are different. So we basically use deep learning and old data analysis to actually predict the future. So when an analyst says it's going to go up, we actually add more value to it by saying, hey, this is our expectation. It's going to go up by this much, and probably it's going to take these many trading days to get there.
Okay, all right. Now, just take me back a little bit, Rajesh. I think a lot of the people on this webinar and the ones who will watch it in the future, um, they are based in India. And I thought we'll bring that perspective as well here. And you are based here in the Silicon Valley. It's pretty much driving a lot of the industries and disrupting a lot of industries in the world. But back in India, what do you think are the opportunities for somebody who's got the technology skills, who's got the chops to learn newer technologies like AI and ML, may have been already working in the financial services industry in the past in a very different technology, in a different capacity. What would be your advice to somebody like that in terms of the skills that they should build, which will be useful in the future, and also the domains within the financial services that you see a lot of opportunities in terms of application of technology. So, what would be your advice to people in the technology space?
So one
Mostly.
Yeah, one of the things is, I think domain expertise starts up. You need to understand what technical analysis is, even before we get into any kind of, what technologies to use. You can actually use any programming language. Preferred, easier one, which is being most widely used today, is R programming. Uh, it's just simple enough. There are enough functions out there in public domain which you can call for technical analysis of a time series stock. There are several packages out there. So, what we used to call people quants before on Wall Street, which are basically either the PhDs or engineers coming in from top universities, and they were given those opportunities. Now, time has come that even a common person and a common engineer who comes from BIT or some other organization, uh, uh, they can actually actively participate in this. In terms of AI, my view is, and I've said this before, that AI is something you need to know what you want to get out of, a pile of data. So AI will not help you normalize the data. How you normalize the data, my application is going to be different in AI versus, let's say, an automobile or big data analytics or something else. Um, if you really ask us, I mean, I have been more on programming in C. I come from an embedded background, routers and switches and those kinds of things, and then later on to embedded security equipment. So price series programming all has been done in C. It's very surprising. And one of my problems is I don't find very many people in that area. But it has been done in C, and it gives us the speed which we are looking for. It may take us a little time to write the program, but it gives the execution speed. Because what is important is if you are going to update the data real time or on a short duration, then what you have to be able to do is process that data and make a decision within few minutes. And that's what it gives us. Okay. So I think specifically get the domain expertise. R programming is another one which you can look at. There are several websites on this area. Quantopedia, I believe, is what they should look at, or they can directly reach out to me and I can help them out. From an alumni point of view.
That'll be very helpful. That'll be very helpful. Um, talking, just taking that point a little bit forward. Do you think that the leading edge work that a lot of the that's going on in the area of trading and technology, do you see that that work will get done here in the Valley and certainly in the US more, and less so in say countries like India, or do you see no reason why it can be done in India as well? And in some ways, will you also encourage entrepreneurs in India and want to be entrepreneurs in India, sort of delve into the area that you have delved in?
So actually, I am actually seeing a lot of companies coming out of India in this space too. Again, they are more focused on technical analysis. People go out, read books, understand. Some of them, are actually coming out of people, who made money in stock market, and then they have hired programmers to build a product for them. In terms of development point of view or technology point of view, it can be done either here or in India. I don't see a problem there. It all depends on what kind of AI you want to put in. Fintech, a lot of companies are coming out. There are a lot of opportunities. Fintech is essentially, this is regulated industry, and the back end process, the individual companies are now bridging that process. And that's where the most of the fintech is actually working. Whereby, where the big banks like Bank of America, JP Morgan could not do it themselves. Somebody else will make it easier to, acquire a loan or a loan distribution. Just a couple of days ago, I was reading about an Indian company which has got $50+ million of funding. Kisht. Kisht is basically, the new pattern is they want to kill the credit cards in fintech, and they essentially, loan sharks are there everywhere, and Visa is a loan shark. They take money from somebody else and they give it to you. So they call it point of sale loan, whereby you buy a big ticket item at any store, whether be it in India, be here, and let's say you go and shop at Macy's and your bill is about $1,500. They already know Macy's has already profiled you. They know that you are a person worth giving a loan. When you go out to pay the bill, there'll be an option for you. Hey, you can take this at $150 a month. And so essentially they are trying to eliminate the credit card, and the loan now comes from a different loan shark. So those kind of things are happening. And I do see that these companies will eventually be acquired by larger banks, because they are A, sluggish, B, they have regulatory requirements on their head. And once this technology becomes popular or more commodity kind of thing, then they will be willing to, you know, acquire a lot of M&A activity. But I should warn you, unlike the technology business, which has a 3-year life cycle, you know, build fast and fail fast scenario of Silicon Valley does not work in this. In this scenario is build slow and fail slow. Because I was looking at Bank of America CEO, and the guy says, hey, well, you can have all the fintech you want. I got 30 million customers with me. What do you do? So I can create a technology, I can create everything, but in order to get to those 30 million customers, I have to go through Bank of America. Those guys are not changing.
Right.
So you have to plan for a much longer term, rather than, you know, hey, I'll build the product in 1 year, and next year I'll start selling, and by the end of second year I should have reached this point, and that's when I go for Series C.
Okay. Okay. Well, you know, in some ways that's good news for us techies, because while, you know, we are all going through these hyper cycles, hyper fast cycles of technology change, and it might be good for, you know, techies to sort of become more important in the world of business. It is also taking a toll on us as learners, because, you know, individually we are not necessarily capable of having such a fast pace of refresh of technology, and therefore it may be affecting our own professional future. Not to say that our end users, which is the banks that you talk about, take a lot more time in sort of metabolizing the technology that we introduce them to and rolling it out to millions and millions of customers, and it takes time. And so there is some comfort in the fact that if we invest into these new technologies and new models, it will take us for a few years in the future. And sort of that's a great takeaway, at least for me, as somebody in the tech business, to sort of focus on. Talking a little bit more about trading, though, you've been so close to it. Do you think stock trading is going to be more machine-led in the future, or do you think as humans we will have a huge opportunity in trading, you know, in terms of as traders and as technology providers for traders as well?
So I do see a big move towards algo trading, and especially HFT, that's high frequency trading. Now, one of the high frequency trading is essentially what we call scalping in this business, which is for a very short, a very small profit, you have a high volume trade come in. And HFT is primarily that, let's say if I want to sell 1 million shares at $2 for something, and there is a guy who's willing to buy the shares for $2.01, you know, same million shares. HFT would try to buy the shares from me and sell it to the other guy for a profit of 1 cent per share. And for HFT, the problem is that it is very technology intensive. You will not believe that the trading algorithms are actually running in firmware inside the network cards. They have to be located within 3 miles so that the fiber latency does not come in of the Wall Street trading. And all these things add up. And essentially, before you make a single piece of profit out of this, it's a $25-30 million investment you have made into a data center, which will actually go out. And I know that few people I know, in fact, a couple of Bay Area companies actually tried this in 90s and 2000s, and they all walked out of that business. The problem was that algo trading, give me a number. I have not seen a number either coming out for Goldman Sachs, Morgan Stanley, JP Morgan, any of the big traders trying to tell me that they made 20% in this year. I have not seen private investors come by and say that they have made 20% per year. Uh, my assumption is that they're making very little pennies in this, very small amounts in algo trading, in the HFT kind of things. Now, if we move a little bit, algo trading is actually making sense, a lot of sense, not on the day trading side, but on the trading side of what you call, what we say, which is a slightly longer term in the sense that it could be from a few weeks to a month kind of thing, whereby you use technical analysis, you don't react to the market up and down right away. And as they said, I mean, there are statistics available. There are day traders who don't hold the stock overnight. Holding the stock overnight actually doubles your chances of making money. And also it is risky. I mean, because next day morning, it might open low. So that analysis you have to do. The other thing which we are looking at which is building it, we actually as priceSeries took a slightly different path. We use algo to make our decisions, but we actually present the algo to the customer or the trader. And the trader can use our analysis and make his own decisions. So we bring in the human factor. We try to avoid, the kind of errors of frequent trading. And we also lead him to, hey, this is the forecasted value. This is the time you should sell. And also along with this, we also tell them what's the sell price every day. That's what we give. So essentially they know the rest point. They know where they are going to, what price they might be going to and how much time it is going to take. Versus if you look at the highest risk, which I see for investors, is Jim Cramer calling in, hey, buy Apple or buy this company. The problem is, Jim said that, yeah, this is the price. Individual investor does not know what price, and when to sell, Jim Cramer will not be found, and what price to sell. So that's where the risk is. If you know the path and it could be charted out for you, then rest is all pure technical analysis. You picked a good company. Did somebody try to say something?
Yeah, let me go ahead. I think there's some questions pouring in, and I will read it out for you.
Okay, so essentially now coming back to the thought. Essentially the customer now has full control in the sense that they can make a decision. And actually, before starting priceSeries, I was actually looking at a robo-trader product. But then when I analyzed, I did not find results from anybody other than academic. And academic results were not very promising. So you have to have a mix of both, algo helping you out with the trade and you making your own decisions.
Well, that's good news again for us humans. I think some people actually make us believe that trading will be something which will be done only by machines in the future, just because of the success in the past. But thanks for putting that in the perspective. I think it makes for a lot more comfortable future than what some of the futurists sort of paint for us. And before I sort of ask you the next question, I think I just want to appeal to everybody who's listening in that you can type in your questions into the chat area, and that way I can sort of read it off for Rajesh to answer. We've got just about a few minutes left, and we'll sort of take it. But by the way, we have one question, so we'll go with that. Saurabh had a question for you, Rajesh, and how can we move out of my current career into AI and data science? I mean, what if you're not into that right now? Should we actually go through some training? Should we go through some certification? Do you have any advice on that?
So I think for general AI, people who want to move into that, they should start looking at few areas. Number one, they need to understand what kind of libraries out there. Okay, AI is just another technology. You are still going to be programming the way you program today. You will probably be using different techniques to be smarter about it. You need to, so one of the things which I will advise is go and look at Google, what Google provides in this area. There are a lot of videos um, on YouTube which will actually talk to you about AI and deep learning. Google is being, their computing is actually being used by a lot of people for data normalization, data finding. Um, Beyond that, depending on what area you want to go in, you might have to look at different programming languages. Common ones are being used, but then how do they use and how do they interface with those libraries? I think those are the ways that you can actually build your own career. Uh, the problem is the hiring. Obviously, the hiring manager is looking for certain things in there, and so I don't think that there is a certification, but I believe Udemy has few courses which you can actually do, and they are fairly valued in the market. You can actually go do some other online courses from different universities. They might give you a certificate and other things, so that might add more resume value than and might be acceptable to potential employers. I think that's the way you can actually look at for a move, but it might take some time depending on where you are.
And thanks for that. And there's another question from Rakesh. It says, does your solution currently operate in Indian equity markets like National Stock Exchange, Bombay Stock Exchange, or is it only in the US right now?
Right now, we are focused in US, but we are coming to India very soon. Very frankly, when we started, we actually built a product using NSE data. I was buying NSE data, and we did try to market initially for about 6 months. The market, we were too early. Then we figured out 70% of this market is in US, so we started focusing back on US. But I promise that in next 3 to 4 months, we will have a product for BSE. Sorry, NSE, not BSE.
Okay. What do you, I mean, this probably could be our last question. Um, by the way, the name of the company for Rajesh, I think a couple of people have asked, is priceSeries. PRICE, priceSeries. Um, so maybe we can close this with a question which has been on everybody's mind, and wanted to know your views on cryptocurrency. Would you put your money or have you put your money behind cryptocurrency? And what is your view for the crypto?
No, I have not. So number one, I mean, we have to understand that cryptocurrency is still a hype. And hypes, as my experience tells me, leaves behind a very good technology. And blockchain is probably the technology. The problem with cryptocurrencies is number one, they got to be legally accepted, which they are not. So if they really want Wall Street or major funds to actually come and start investing, there has to be much more transparency. Right now, they are actually trading. It's a very centralized trading. They got exchanges all over the place. But then the problem is it's not decentralized. The transparency is just not there. The government, regulation wise, I mean, I know RBI in India has already said no to this. All banks have said no to this. They have said don't use your funds or use through us, don't transact buying Bitcoins or other things. This has already happened. It has not happened in US, but it could very well be coming. There'll be some time before governments can figure out how to tax this and make money out of this whole thing, and also have transparency, because people's money is involved in this, public money is involved, and it falls into a very different kind of a regulation. So decentralization is something which I'm actually looking at to happen first. Otherwise, it is a fairly good, speculative investment for people who actually came in early. I know there are some people. Bill Draper is actually looking at Bitcoin to go to 250K a single coin. He is a big investor. Far East has been very active in this whole area. But from a pure financial instrument point of view, I don't think it's a standard financial instrument at this point.
Well, on that note, Rajesh, it's been such a pleasure. We thank you for your time and for your kindness to share your views. I think a lot of our listeners will end up sort of reaching out to you after this. But I think a great place for everyone who's on this web chat to actually hear more about issues like this and in more detail in flesh and blood would be at the BITOSA Global Conclave on December 1st, where we have a whole panel on finance and financial services and the technology role of technology there. So please make sure that you register for that event on bitosaglobalconclave.com and see us there. Once again, we will thank Rajesh here on behalf of everyone and all of the BIT alumni, which is going to hear this in recorded sessions in the future. Thanks, Rajesh, for your time.
Thank you, Subhash, and thank you, everyone. For those based here, have a nice day and good night to everybody in India. Bye.
Thank you.